The first thing that a trader must understand is risk management. Risk management is even more important than knowing how to trade. The best way to manage your risk is never to risk more than 1% of your total capital or have 5% at risk at any one time. How do you calculate risk? I'm going to use a vehicle here. This is the Dow Diamonds, what they call the Dow Diamonds. You might have heard the commercials on the TV about the Dow Diamonds. That's what this is, the DIA. It tracks approximately 10% of the Dow. The Dow Diamonds closed at 191.90 and the Dow Futures closed at 18.8. I don't know what the Dow itself closed at. Okay, 19,173. So the Dow Diamonds 191.90 and the Dow 19.1. So pretty close to 10%. Say you wanted to take a trade in the Dow Diamonds. This is just hypothetical. Okay, this chart does not have is not telling you to buy. Okay? Actually, I'm long right now and I have another person long and we're waiting to see what happens here. So if you have, just hypothetical, and your numbers will be different than the numbers I use, okay? If you have $20,000 in a trading account, okay? 1% of that is $200. Now, what you need to do is you need to decide how much you're willing to lose. Well, your 1% is max. Okay? Your 1% is max. Now, in most cases, this is a daily chart. Okay? We have an average true range. You see, all my stuff is set on exponential. You'll figure that out later. We have an average true range. This is a daily chart. And in most cases, you want to give enough wiggle room for whatever it is that you're trading to move at least one average true range prior to being stopped out. What I do is I take the average true range and I take it times 0.16. So the average true range right now for the Dow Diamonds is $15.81. $15.81. I multiply that times 0.618. 0.618 is a Fibonacci number. So that's $9.77. So $9.77 plus the average true range is $15.81 is $25.58. You take that number, 25.58, let me write that down, 25.58. And you multiply, you divide your $200 by that. So with your $20,000 account, if you were going to take a trade in the Dow Diamonds, your maximum position, I round up or round down depending on what side of 5 I'm on, is 8 shares in this one trade. Okay, now that doesn't sound like a lot, and it's not, but that isn't what matters. What matters is you learn to manage your risk, because if you manage your risk, you will do better than half the traders out there. Right out of the chute. That's why risk management is my very first class. Trust me, it does not feel good to blow up an account. I've done it. And it can rock you to your core. I started trading real money with $17,000. I knew nothing. But I didn't know what I didn't know. Knowing now, I knew nothing. Okay? So, say for example, you work and you've learned my way of trading. Okay? And say for example, this trade works. It gets above this line, gets above this resistance, gets above this resistance, and say with the Dow Jones, I mean, you could be in the trade for weeks, months, depending on what happens in the overall market. Okay, so say it gets up to this high, 295.87. We're at $191. Okay. Now keep in mind you're only risking $200. Well, a little bit more because you went with 8 shares instead of 7, but you can go 7 if you want to stay completely within your risk. There's nothing wrong with going with 7. So let's use that. Let's use 7 because we came up with 7.8. So let's go with 7. So yesterday was Friday, so the market's closed now, and the Dow closed at 191.90. Or the diamonds did, not the Dow, but the diamonds. And say we get up to 295.87. 295.87 minus 191.90. And say it went straight up. Okay? Say it goes straight up because it can't because it could. You will have made $103.97 a share times 7. That's $727 of profit, risking 200. So you have made over 3 times as much as you risked. That's about normal for a trade. You want a 3 to 1. You want a target that gives you a 3 to 1 profit, if at all possible. Me as a day trader, um, and as a long-term trader, and as an investor, I don't worry about that. But then I'm in front of this screen for hours, hours a day, hours a week, hours a month. But say you got into this trade and you go to work, okay? You look at it once a day. When you learn how a trade comes together, you will learn what the next thing you need to see happen is. Now, price may get up to the top of this candle, and you might get a sell signal. We'll get into sell signals down the road. So this high, say say it got up there and it closed below at 251.28. 251.28 just for GP. 251.28 minus 191.90. $59.38 times your 7. You still made $415, risking 200, and you doubled your money. That's one trade. As your account gets bigger, because now you'd have $20,415. $20,415. Your risk parameters are going to go up. So now in this case, you can risk $204. And you're still only risking your 1% capital. And you only have 5% at risk at any one time. That means you that means you can have 5 trades going at once. Okay? You have 5% at risk. You might have a loser, you might have 2 losers, 3 winners. In time, what you want to get to the point of is 7 out of 10 trades are winners. Okay? As price proves itself in a trade, okay? If price got above here, closed above here, and it was telling you wanted to go higher, you'll bring your stop up. You'll have stops. Stops are where if price gets back down there or back bounces back up and hits your stop, it'll automatically take you out of the trade. You take your profits and you go on to the next trade. That's what stops are. So if price closed above this, you could put your stop, down around here somewhere. Let's see, that's 262, 250, 250, so that'd be $12. So it'd be a little tight, but the ATR will also change. The ATR changes every day. Every day. So you can adjust your stop if you want to. I don't. I move my stops up when price proves itself. For example, if we get a buy signal here and it tells me it wants to go higher, the next step is getting above this red line. Okay? If it gets above that red line, I'll maybe bump my stop up a little bit, maybe not, and let it start proving itself. We get a close above this, that would be my next step. Its price is going to have to get above that before I know, or I shouldn't say no, you never know, before the probabilities are on my side that it's going to continue to go higher, because this is daily resistance. Okay? So, but as I explained, you'd already be in decent profits. You'd have a you'd have a 2-for-1 win. That's what they call a two bagger. Well, you double your money. If I double my money in an options trade, I'm automatically out. You gotta control your greed and your fear. Learning how to trade, knowing what price has to do to keep you in the trade eliminates fear. Okay? Let me show you on my oil trade. I got in on oil right around here, right here. It broke below this support right here. This was daily support in oil, and I got in right here. I could have gotten in back here, but I didn't. I got in here. And as price proved itself to me, it took the fear out of my trade, and I've ridden this down all this. Okay? And it's going lower. Risk management is your number one thing in trading. Don't risk more than 1% or just over. Like I explained, the 8 shares versus 7, and no more than 5% at risk at any one time. That gives you the ability to get into 5 trades. Then go to work. If you work, I suggest you at least trade on a daily chart, if not a weekly or even a monthly chart. Then you only have to look at it daily. If you're trading on a monthly chart, you only have to look at it once a week. Okay, what did it do this week? Okay, it's going to keep going, or the probabilities are that it's going to keep going. People call trading the stock market gambling. It's not true. It's not true at all. Gambling in the stock market, or risk in the stock market, is not the stock market itself. It's the person trading in the stock market that hasn't learned what they're doing that causes the risk. Figure out where you want your stop. In this case, it was 25 and some dollars is the maximum you want to lose, and you are willing to lose in this trade if the trade goes against you. And just so you know, you don't have to wait for that stop to get hit. If you learn to read charts and to trade and so on and so forth, and you find out you're dead wrong, you don't have to wait for for that stop to get hit. You can get out. So you might get out with a $9 loss. Okay, well that's a heck of a lot better than 25. So don't think you have to give up that $25 because you don't have to. If you find out right away that you're wrong, if the whatever you're trading does exactly the opposite of what you expected, get out. Managing your risk will prevent you from having to be right. You're not going to be right all the time, and you're not going to know when you're going to be right or when you're going to be wrong. You have no idea what that vehicle is going to do. You have no idea. So you have no control over that. You have control over how much you lose if you are wrong, and you have control over how much you win if you're right. To a certain, to a certain point. But you will learn down the road what it has to do to keep you in the trade. Learning how to manage risk takes a lot of fear and a lot of greed out of your trading. Okay? And that is what is needed. Fear and greed are a major component and roadblocks to trading for a lot of people because they hang on too long, or they don't get out having to because they have to be right. You don't know when you're going to be right and when you're going to be wrong. So control the things that you can by controlling the amount you lose in a trade. And I suggest that be 1% per trade, 5% at any given time. If you have any questions, shoot me an email, give me a call, give me a text, and we'll talk. Okay? Take care.